Welcome to the deep dive. Today we're charting a course into cruise line stocks. Specifically, we're looking at a recent piece from The Motley Fool, dated April 11th, 2025.
Right. And they've picked out three companies, calling them no-brainer buys right now.
Exactly. So our mission, for this deep dive is really to unpack that article. Why these picks? What's the state of the industry?
Yeah, we want to understand the reasoning, look at the bigger picture for cruises, and just lay out what the article suggests. Makes these stocks potentially interesting for someone curious, someone learning.
And it's an interesting time, isn't it? Because the cruise sector, well, it had a strong couple of years bouncing back.
Definitely.
But 2025 hasn't been smooth sailing for the stocks.
Yeah.
The article points out the big operators are down significantly, like 29%, 17%, even 35% declines this year.
Yeah, quite a pullback. And the full article does touch on some possible reasons. There's this renewed chatter about trade wars, which always creates uncertainty for international travel, maybe hits consumer spending through tariffs.
Yeah.
And the article also mentions potential concerns about, well, xenophobia maybe impacting travel sentiment.
Right. Those are definitely factors floating around. But the key thing here, the author's perspective in this piece, is that this dip, it's actually a buying opportunity.
That's the hook. They see it as a chance to get in. So we need to dig into why they think that.
Okay, let's dive into the first one then. Carnival Corp, ticker CCL.
Right, Carnival. They are, as you'd expect, the absolute giant in this space. Biggest by revenue, biggest by passenger volume. Hard to ignore them.
And their recent financials, specifically that first quarter report from just before the article. How did that look?
Actually pretty strong considering the stock's recent performance. The fiscal Q1 numbers, which came out about 3 weeks before the article, showed an 8% revenue increase.
Okay. It did
$5.81 billion. And importantly, that was actually ahead of what analysts were expecting. They were forecasting around $5.74 billion.
So the business itself is performing better than maybe the stock price suggests.
That seems to be part of the argument, yeah. And profitability is another big piece. They actually turned things around from a loss a year ago.
Right.
And maybe more impressively, they've now had 7 straight quarters where they've beaten Wall Street's profit targets.
Not just beaten, but often by quite a significant margin.
7 quarters in a row. That's consistent.
It is. It suggests something's clicking operationally. The article lists some specifics, these EPS surprises.
Yeah. Like what?
Well, back in fiscal Q3 2023, the estimate was $0.75. They hit $0.86. That's a 15% beat.
Okay.
Then Q4 2023, analysts expected a loss of 13 cents. They only lost 7 cents. That's a, 46% surprise?
Wow.
And even more recently, fiscal Q1 2025 just reported the estimate was $0.82 earnings per share. They delivered $0.13.
13 cents versus 2. That's huge, like a 485% surprise.
Exactly. So you see this pattern of consistently outperforming expectations on the bottom line. It catches your eye. Absolutely. That kind of track record, well, it makes you wonder. And what about looking forward? Bookings.
Good question. The article highlights that, too. Apparently, Carnival reported $7.3 billion in customer deposits for future trips.
$7.3 billion.
Yeah, and that's supposedly the highest they've ever had at this specific point in the year. So it suggests demand is still really robust. People are planning those cruises.
Okay, strong performance, strong bookings. What about the valuation? How does the market see it?
Well, the article points out the trailing earnings multiple looking back is just over 11 times. But looking forward, based on analyst estimates for this year, it drops to about 9.4 times. And for fiscal 2026, it's predicted around 8.3 times.
So getting cheaper on a forward basis, assuming they hit those numbers.
Right. Generally, lower forward multiples can signal, potential value if the earnings come through as expected.
But there's always a but, isn't there? The article mentions a big one, debt.
Yes, that's the major counterpoint. Over $25 billion in debt. That is a lot.
$25 billion. Okay, what are the risks there?
Well, the author points out 2 main things. One, if interest rates climb higher than expected, maybe inflation sticks around.
Yeah.
Servicing that debt gets more expensive, squeezes profits. And 2, when you look beyond just the stock price and consider the whole company value, including debt, what they call enterprise value, those earnings multiples we just talked about, they basically double.
Ah, okay. So it doesn't look quite as cheap when you factor in all that borrowing.
Exactly. It paints a more, let's say, complete picture of the financial burden.
So it's this interesting balance. Strong results, good bookings, potentially attractive forward PE, but this huge debt overhang. Yet the Motley Fool author still lands on it being a no-brainer buy.
The argument seems to be, yes, the debt is a risk, but the operational momentum, the industry leadership, and those consistent earnings beats make the current price attractive enough to outweigh it. A value play, essentially.
Got it. Let's shift gears then to the second pick, Viking Holdings, ticker VIK.
Viking. Now, this is a different kind of cruise company compared to Carnival. They're really a leader in a specific niche. River cruising. Smaller ships, more luxurious, going places the giant ocean liners can't. Think European rivers, that sort of thing.
Oh, okay. More specialized.
Very much so. And historically, this focus has allowed them to grow faster than the big traditional lines.
And how's their stock holding up this year compared to the others?
Better, actually. The article notes it's only pulled back about 11% year-to-date, much less severe than the drops we saw with the majors. More resilient.
Interesting. Does their target audience play into that?
Probably. The article says they cater to an older, more affluent crowd. They rely a lot on repeat business, direct marketing, and that the ships themselves are smaller, usually under 200 passengers. It's a very different vibe.
Right, more intimate. And what about their bookings? Similar strength to Carnival?
Seems like it. The article mentioned that as of February, Viking already had 88% of its 2025 capacity booked up.
88% back in February. That's really high.
It is. It gives them a lot of visibility into their revenue for the year. Very strong demand signal.
So niche focus, stock resilience, strong bookings. But what about the price? You often pay up for that kind of quality, right?
You do. And the article confirms Viking trades at a premium, about 17 times this year's projected earnings and roughly 13 times next year's target.
Okay, so pricier than Carnival on those metrics.
Definitely. The market seems to be recognizing that growth, that stability in their niche. You're paying for that perceived lower risk and consistent execution.
And what about their debt? Is it anywhere near Carnival's level?
That's a key difference. Well, according to the article, Viking has the best balance sheet of the three. Less than $5 billion in long-term debt.
Less than 5. Compared to over 25 for Carnival. That's a big contrast.
Huge contrast, much lower leverage. Which, in uncertain economic times or if rates do rise, that's a significant plus. Less financial risk baked in.
So with Viking, the thesis is more about paying a premium for niche leadership, strong growth, and a much cleaner balance sheet.
That sums it up well. Yeah, stability and focused growth, but at a higher valuation multiple.
All right. That brings us to the third and final company highlighted, OneSpaWorld, ticker OSW. This one sounds different again.
It is quite different. They aren't a cruise line themselves. They operate spas and wellness centers.
On ships?
Primarily, yes. The article says they're on 199 ships across basically all the major cruise lines. They also have a presence in about 50 land-based resorts, but the cruise ship business is the core.
And the article called them an unofficial monopoly on board. That sounds strong.
Yeah, it's an interesting description. The reason he seems to be that running spas successfully on ships is actually quite challenging.
Oh, how so?
Well, logistics, staffing, maintaining quality across a moving fleet. Apparently, many cruise lines tried running their own and struggled to make it work well or profitably.
Ah, I see.
So OneSpaWorld has specialized. They recruit globally. They have their own training centers. They've built this expertise that cruise lines find easier to just outsource to them. It creates a sort of moat.
That makes sense. A specific skill set for a specific environment? How are their financials looking?
Pretty good, according to the article. Revenue was up 11% in the latest quarter, and operating profit jumped even more, 37%.
37% profit growth. Nice.
Yeah, suggests strong demand for those spa services on board, and maybe good cost control, too.
Okay, and valuation. Where does OSW sit compared to the others?
It's trading around 17 times this year's estimated earnings and about 15 times next year's. So somewhat similar multiple to Viking, actually.
Interesting. So the market sees growth potential there, too.
Seems that way, likely valuing that unique market position and the growth trajectory.
And the debt, given they don't own ships.
That's the kicker. Very little debt. The article mentions less than $100 million in long-term obligations.
Wow. Okay. Tiny compared to the others.
Exactly. They have what the article calls an asset-light model. They don't have the massive costs of building, buying, and maintaining cruise ships.
Right. They provide the service but don't own the venue, essentially.
Precisely. It gives them a lot more financial flexibility and means they aren't saddled with those huge capital expenditures and the associated debt. They benefit from cruise travel without the shipyard bills.
Okay, so let's just recap these three Motley Fool no-brainer ideas.
Mm-hmm.
You've got Carnival, the giant. The argument is value based on strong earnings beats and bookings. Despite that, significant debt load.
Right, the potential value play.
Then Viking, the niche leader in river cruises. Premium valuation, yes, but you get stability, growth, and a much healthier balance sheet.
A stable growth story.
And finally, OneSpaWorld. Not a cruise line, but a key service provider. Asset light, dominant in their spa niche, growing nicely, and almost no debt.
The specialized service provider angle. Yeah, 3 distinct cases.
Definitely catering to different investor appetites, maybe
Yeah.
different views on risk.
For sure. But it is crucial, and the article hints at this too, to remember the whole sector is sensitive. Those broader economic worries, the geopolitical stuff, trade war talk, travel sentiment. Those things that maybe caused the stocks to dip in the first place, they could still be headwinds for all 3 of them.
Absolutely. So, no-brainer might be the author's view based on the company specifics and current price, but the overall environment for travel and cruising still has uncertainties. That context is key.
Definitely something for listeners to weigh up. Which actually brings up a final thought to leave folks with.
Yeah.
We've seen 3 very different business models here, all tied to the cruise industry, right? The big operator, the niche specialist, the service provider. It makes you wonder, what other industries that seem like one single thing might actually have these diverse ways to play them? Different kinds of companies with different risks and rewards, even though they're all connected. Something to maybe explore when looking at other sectors facing uncertainty.